Hi, you're watching Investor Insights. I'm Vic, and in this video I like to talk about when the markets are going to crash. And again, this video is made as a result of many emails sent to me asking me that very question. Well, nobody can really tell when the markets are going to crash. All I can say is they are going to crash, and they're going to crash in a spectacular way. So stock markets first and foremost, the housing market, more so in Australia than in America because they've already crashed there, and also the bond markets, which essentially have been hemorrhaging since last March. You're looking at a 10-year yield of almost 3, and that's come up from a level of below 1.5. Monstrous amounts of capital losses to those suckers who bought in at or round about the 1.5% mark on the 10-year last March. But essentially, what warning signals are there? What can you use as an alarm bell, or like a dead canary in a mine, to warn you about these stock market collapses or other market collapses? I like to look more so at stock markets today because that's the easiest one to work out. I say that because house prices can still be very subjective and people don't want to listen, so I'll discuss that in another video. Now, when you ask me when the stock market's going to crash, or the warning signs, it's like asking a person who was inside the World Trade Center on the morning of September 11, 2001, what warning signs there were of the collapse of the building, or whatever the passengers on the Titanic's maiden voyage had as a warning signal before the ship went down. Essentially, these things happen. But when stock markets are overheated, common sense will tell you to be getting out. At least take some profits, if not take all your profits, and get out and stay out. Stock markets can keep on going past their valuation for a long time, just as anything can get past their realistic valuations for a long time and for a great amount. But essentially, do you want to get into a market that's rife with speculation and get blown up when you find out that you're the biggest fool? Or would you rather ride it somewhat part of the way, lock in your profits, and live to fight another day? Buy when there's blood on the streets, not when there's euphoria. That's when you sell. So as I said, the markets, the S&P 500 has risen 30% last year, which is its best year since 1997. That's to tell you the magnitude of the market's gains in the past little while. And I describe it as a hyperbolic manic phase. Now, to those who don't know, a hyperbola in maths just looks like one of these. So the gains accelerate quicker and quicker the further you advance. Now, some analysts incorrectly call it a parabolic move, but as we all know, a parabola looks like a U, so not correct. The last time I saw a hyperbolic or parabolic move was essentially with crude oil in 2008. You can say 2007, 2008. Now, this move saw crude oil at $50 in basically May of 2007, and by the start of June in 2008 it reached $100. So it essentially doubled in 13 months. But it took just the month of June and a few days at the start of July to get from 100 to 147, which is still an all-time high. So to make the first 50 took 13 months, and to almost make the next 50 took less than 5 weeks. That is a parabolic move, or a hyperbolic move. The stock market is behaving very similarly, but not on such an aggressive time scale. You're looking at the last year of the S&P having risen 30%, so you can almost see that straight up manic phase. I call it manic because everybody's piling in, and when people are piling in, irrespective of whatever P ratios there are or economic situation that there is, everything is Fed dependent and QE dependent. And you know you're playing a dangerous game of cat and mouse when you're getting into stocks hoping for bad data to come out so the Fed doesn't taper or increase its purchases to keep the economy going. In fact, based on the last video, QE doesn't get the economy going, it merely inflates these bubbles. You cannot increase economic output by increasing QE, you merely inflate the price of everything. So in fact, what you deem as economic growth is not even that. It's inflation masquerading as economic growth. But that's the story for another day. So whenever you're looking at the S&P trading near or just over 20 times, you know this is practically an all-time high. You know that there's a huge correction on the way when people finally realize that they are the biggest fools. When you look at, just for argument's sake, other warning signals, red flags, like the financials and property sector in the ASX 200 has crossed over the 40% mark. Now, would you believe that banking and real estate now forms 40% of the weightings in the ASX 200? I mean, if banking and real estate was 40% of GDP, you'd be in big trouble, because essentially it's two big bubbles being blown up at the same time, potentially a third when you're dealing with bonds as well. So where were you on October 18th, 1987? The day probably started off just as any other day, and you probably didn't see anything out of the ordinary happen. But what followed was a 22% fall in the Dow Jones Industrials. In terms of percentage point, it's still the biggest fall ever recorded. I mean, 22%, it's over 1/5, almost a quarter of your statement just torn up. Just like TechRec. Where were you on March the 10th, 2000? You didn't see it coming. People were still buying stocks, people were jumping in, people were eager, they didn't care about valuations. The Nasdaq reached such a high that to this day we're still nowhere near that high, and it's 14 years later. One cannot tell. So if you ask me what warning signs to look out for, well, I'm one of them. I've been saying this for quite a while. But the Nasdaq just kept on going up through 98, 99 and 2000, and eventually it blew up. And when it blew up, it lost 80% within a year, within a smidgen. Look at crude oil. It went from 50 to 100 in 13 months, and in 1 month it jumped almost another $50. So what happened afterwards? Within 6 months it retreated back to 32 by February of 2009. So just because you see prices rise and you see people jump on board and everybody's high-fiving and stock markets are making headlines all over the news, for the right reasons that is, you know it's time to sell out. On Main Street, if you walk into a butcher's or you catch a taxi and the taxi driver tells you, oh, I've got a stock market tip for you, or your butcher then turns around and gives you advice on picking technology stocks, you know it's time to let go. Ultimately, it all comes down to making a decision, following your heart or your brains. There is an overwhelming desire to chase those returns because everybody's doing it. And missing out just puts a gaping hole in your existence, especially when people who are getting wealthier on paper are buying nice cars, nice houses, and spending it like there's no tomorrow. But just like 1987, just like 2000, just like 2007, doesn't matter if it's stock market, housing market, bond market, when this stuff crashes, all that paper wealth will vaporize. And the question is, do you want to have all your money tied up in all these overpriced assets?